Hello, and welcome to the November episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. We are glad to see you again. Coming up on today's program, how can financial advisors and investors reduce the bite of taxes? We will tell you about a new actively managed municipal bond ETF that could take a bite out of your tax bill. We will also share more about a new money market ETF with the goal of capital safety, liquidity, and stable income. Plus, generative AI, it is projected to become a multi-trillion-dollar industry in just a few years. We'll examine a pair of thematic ETFs targeting this exciting new arena of technology. But first, we kick things off from the New York Stock Exchange. Joining us now is Maital Legum. She is from the NYSE. And Maital, it is great to see you.
Great to see you too, Stephanie. It's great to join you for another episode for November.
Yes, can you believe it's November already? Let's begin, as we always do, with an update on the latest ETF launch activity. What are things looking like?
Sure. So, we continue to witness robust activity in the ETF space with a total of 3,811 ETFs with $10 trillion in asset under management in the U.S. market today. So, as we head into year end, we're certainly on track for a record number of ETF launches driven by a lot of product innovation and demand.
We've been talking about the conversion of mutual funds to ETFs, and we know that this has boosted both ETF assets and the sheer number of funds. What's been contributing to the conversion trend, and do you see it continuing?
So to date, we've seen a total of 89 mutual fund conversions amounting to $73.4 billion in assets transitioning into the ETF structure. In just this year alone, we have seen 15 conversions, which have brought in $3.4 billion in assets under management. As more fund managers recognize the advantages of the ETF structure and respond to investor demand and greater flexibility, we can expect to see additional conversions in the coming months and years.
And Maital, before we let you go, what other trends are you guys monitoring as we move forward?
We continue to work with asset managers on new and innovative product structures. We've seen a lot of activities and demand for new ETF structures such as buffered and single stock ETFs. These innovations are enhancing the flexibility and the growing available investment strategies in the ETF wrapper. We have also seen several of the ETFs in registration seeking approval from regulators to give investors access to private credit, which historically has been really hard to access. So with all these exciting developments, we continue to focus on making access to information really easily and available for all of you. So go to etfcentral.com and catch up on the latest ETF news and trends and all that is happening here at the NYSE, the home of ETFs.
And there is a lot happening indeed. Maital Legum, thank you so much. It is great to see you.
You as well.
And just a quick reminder, you can watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. We also simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms, so don't miss it. Managing cash is an important aspect of portfolio management. It is one thing to have cash. It's an entirely different thing to know where to put that cash when it's not invested in the stock market. Well, a new ETF from Texas Capital is a money market fund aiming for capital safety, liquidity, and stable income. Well, here to explain is Daniel Hoverman, Head of Corporate and Investment Banking at Texas Capital. Welcome, Daniel.
Thanks for having me, Stephanie. Really appreciate you having me on.
Oh, you're very welcome. Before we talk about the Texas Capital Government Money Market ETF, and that ticker is MMKT, bring us up to speed about investing in money market funds and the potential benefits of now doing it with an ETF wrapper.
So when you think about how you can manage liquidity in an investment account, historically you've had either just pure cash where it's really acts like a checking account, didn't really earn a lot of interest on it, or you had a money market fund. Money market funds give you a very defined parameter that's set out in the 40 Act as to what you can invest in, the amount of liquidity that you have to have, the duration of the investments that underlie that fund. And it gives you a lot of safety and certainty in terms of preserving principal and making sure that you have a return that is meaningful in the context of the interest rate environment. Over the last 2-3 years, interest rates have risen very dramatically. And the cost to the investor of investing appropriately and earning that yield on current funds is really important. The difference for an ETF, though, is that an ETF is intraday liquidity. So if you sell it, your broker will usually give you ability to reinvest those funds immediately. Whereas in a money market fund, or really any mutual fund, you don't get liquidity until the end of the day. So there's two things that go together that our new fund is very unique. It is the first ETF that is qualified under Rule 2a-7 as a money market fund. That means from an accounting perspective, it's the same as a cash and cash equivalent. If you're a corporate treasurer and you have to worry about GAAP accounting, you don't have an investment in securities, you actually have a cash equivalent. And so you may be able to comply with governmental investment or other constraints on using your capital. But then it also is an ETF. So it gives you a little bit, frankly, better disclosure. We have a 7-day yield that is reported. We have much more frequent visibility into what securities are part of that, the trust of what you've invested in. But you have the ability to have same-day liquidity, and for any money manager or investor that wants to be able to reposition their portfolio quickly, you make a decision today and you can reinvest today instead of making a decision today and reinvesting tomorrow. We think that the MMKT gives some very unique advantages that so far aren't available anywhere else.
Yeah, and when we take a deeper dive into MMKT, again, it's the Texas Capital Government Money Market ETF. You mentioned liquidity. You're aiming for that and stability of principal. Tell us a little bit more about the fund, what does it own, and a little more about how it works.
Sure. So the fund itself, in terms of what it owns, it has to comply with the assets that are specified in Rule 2a-7 of the 40 Act. That by and large means that you are investing in short duration government funds and U.S. government funds and in repo. So there's relative to a comparable Treasury bill fund that's also investing in short-term U.S. securities, there's a little bit more flexibility within the 2a-7 rules to find different pockets of liquidity that might offer you a slightly better yield. With that being said, you are still very short duration, and you have a maximum maturity that's specified under Rule 2a-7. So because of the envelope of that rule, you always have this outer limit as to duration risk that you would take in terms of the investment.
So how might an ETF like MMKT be deployed by advisors and investors inside a diversified portfolio?
So we think it really is a superior way to think about using your cash, right? Everything has a liquidity premium. If you have to wait one day to reinvest, there should be a premium for that amount of illiquidity. And so as any investment advisor thinks about how to manage cash and how to think about the balanced portfolio between debt, equities, cash, and other assets, if you have an alternative that allows you to reinvest funds and reposition the portfolio easier, that usually is going to be a superior fund. We think that it will be in line with other comparable cash equivalent products from a yield perspective, and it really offers a superior accounting treatment, we think, and hopefully a competitive liquidity profile.
All right, Daniel Hoverman, we will leave it there. Thank you so much for introducing us to MMKT. It's great to have you with us.
All right, thank you for having me.
Municipal bonds have long been a tax haven for investors seeking to minimize the threat of taxes. There are currently more than 50,000 different municipal bond issuers compared to just 10,000 listed corporate issuers. So the muni bond market is vast and complex. Well, the new actively managed municipal bond ETF from Rockefeller Asset Management is one potential tax solution. Let's welcome Alex Petrone, Director of Fixed Income at Rockefeller Asset Management. Hi, Alex. It's great to have you with us.
Great. Thank you, Stephanie. Great to be here.
Okay, so before we talk about your opportunistic municipal bond ETF, and that ticker is RMOP, what are some of the challenges facing tax-averse investors?
Yeah, I think first and foremost, for U.S. domiciled, high tax paying investors, we believe tax exempt municipals, both high grade and high yield, offer really compelling relative value versus other high grade and high yield fixed income that's out there. But you're absolutely correct, Stephanie. Investing in tax exempt municipals is not without its challenges. And I think the three main ones that we think about today is ongoing rate volatility that you see stemming from this continued economic uncertainty or macroeconomic uncertainty. I think number two, identifying and sourcing best relative value can be really challenging in the municipal market. And then number three, which you alluded to, underwriting credit to navigate what's a deeply fragmented market with those 50,000 plus active issuers today. So when we break those three down, we think about rate volatility. This move higher in yields has led us to what we believe is a really compelling entry point for long-term investors looking for tax efficiency. Whether you look at the Bloomberg Municipal Bond Index that's currently yielding about 3.62%, or the Bloomberg High Yield Municipal Bond Index that's yielding about a 540 tax exempt. That's 6.11%, 611, or 9.12% tax equivalent yields, respectively, for investors in that highest marginal tax bracket. So many might argue that that's really compelling today. With respect to really thinking about that point number two, identifying and sourcing best relative value, that can be really challenging for investors today. We think it's critically important to have deeply experienced teams that can capitalize on the many opportunities through relationships that we've built through time with bankers, with borrowers, with underwriters that really stem from several decades of cultivating relationships and being able to have access to the entirety of the primary market as well as the entirety of the secondary market. And then on the credit side, that kind of third really key element that's challenging for investors today in this deeply fragmented market, you really benefit from strong bottom-up credit analysis. There should be a focus on investing across the entirety of the municipal market. And I note that because you see many that focus on the large, well-known borrowers, but it's important to focus down to those small, more bespoke opportunities that offer some really compelling excess yield opportunities today. If you are doing the strong bottom-up credit work, something that we think is critically important for investors. So it really gets down to underwriting as well there.
Yeah, so taking a deeper dive then into the Rockefeller Opportunistic Municipal Bond ETF, and again, your ticker is RMOP. It's an actively managed muni bond fund. Tell us a little bit more about some of the fund's unique strategy and maybe some of the holdings.
Yeah, absolutely. So I think first we want to focus on the unique investment team. This strategy is managed by a deeply experienced portfolio management team. We bring an average 26 years of experience, 20 plus years investing side by side together, overseeing more than 25 billion in municipal assets at our last stop. We've navigated through some really challenging macro as well as municipal cycles. And I think it's really important to have that deep expertise as we move through continued challenging times. I think shifting to the strategy, a really key focus for us remains targeting high tax efficient income and yield. We firmly believe, and we've seen it through time, that yield is a key driver of total return for investors through a cycle. And if you're able to target relative value opportunities across the entirety of the municipal market, high grade, high yield, you will be able to deliver alpha. We believe you will be able to deliver alpha to clients through time. On the high grade side, we're really thinking large liquid issuers that offer attractive relative value, key stores of liquidity within the strategy. On the high yield side, I want to get back to that idea of 40,000 active issuers in our market today. Some of them are less trafficked by most active managers today. We find tremendous relative value going down to smaller borrowers that are overlooked. So that is really focusing on the 30 million and less of issuance in the market. That is more than 50% of issuance on an annual basis. What you tend to find in that space is an opportunity to get some excess yield, excess premium because of the complexity or the liquidity differences in the market today. So what you'll notice across our ETF is navigating into that space and having a blend of some of the high yield beta that exists in the market, the high grade liquid issuers that are a key store of liquidity, but then really navigating into this bespoke investment opportunities where you can get that excess yield premium that you focus on through time. I think the other side of that ledger is ensuring that you're not necessarily buying everything. The bottom up work sometimes leads us to not investing in some of the yieldier issuers that are out there. And we've noticed in the last many weeks and months is the high yield municipal market has had a lot of demand. It gets a little crowded. So it really is about looking for relative value and strong bottom up credit work.
Yeah, before you take off, how do you see the ETF deployed inside a diversified portfolio?
Yeah, I think that investors, we believe, will benefit from including an opportunistic municipal strategy, RMOP, as a additional part of their municipal asset allocation. So we find investors typically have an allocation to high grade municipals through an SMA or another fund within the investment grade space. We believe investors may benefit from adding some yield and alpha opportunities, including a 10 to 20% allocation to an opportunistic municipal ETF that can really augment returns through time by focusing on some of those areas of the market that I mentioned that you're not typically going to see in your high quality space.
All right. Thanks, Alex, for your insights. Good luck to you. Generative AI is projected to become a multi-trillion-dollar industry in just a few short years. It is also creating a lot of new companies with juicy valuations and capital inflows. We'll here to discuss a pair of ETFs targeting the exciting arena of generative AI and technology is Jay Jacobs, U.S. head of Thematic and active ETFs at BlackRock. Hi, Jay. It's great to see you.
It's a pleasure to be here.
So before we talk about BlackRock's newest pair of actively managed technology ETFs, tell us about some of the challenges facing advisors and investors looking to enter the AI and technology market.
Well, I think most advisors and frankly, most people paying attention to the markets and to technology development see artificial intelligence as a major breakthrough, as probably one of the biggest technological developments since the internet, is really creating massive amounts of economic growth due to the utility of this technology. But the challenge that advisors face is, one, understanding what artificial intelligence exposure they have in their portfolio today. I think many already have some exposure due to the Mag 7 mega cap stocks that represent such a big portion of the S&P 500 are in many ways AI stocks, or at least a component of them has to do with artificial intelligence. But they don't have a way to navigate the entire AI value chain. What is the opportunity beyond the Mag 7? If I want to upweight or change my allocation to artificial intelligence, how can I do that very efficiently in my portfolio? Artificial intelligence is not just the Magnificent Seven. There are dozens of companies in the United States, additional companies around the world that are leading across the AI value chain. That means companies that are developing large language models. That means companies that have proprietary data sets, companies developing revolutionary semiconductors, data center companies that are developing the physical real estate behind artificial intelligence, and of course, new companies that might just be building applications for the very first time that leverage artificial intelligence in their products. So you can think about this very expansive value chain of companies, and yet most advisors only have kind of a basic exposure to a handful of them through their core equity holdings. We believe that that's really not a comprehensive way to think about this theme.
Yeah, that makes a lot of sense. So you have added two new ETFs to your lineup, the iShares AI Innovation and Tech Active ETF, and that ticker is BAI. And then we have the iShares Technology Opportunities Active ETF, that ticker is TEK. So let's talk about these two. How do they compare and what are some of their holdings?
So both of these are actively managed ETFs, and they're managed by our fundamental equities technology portfolio managers, including Tony Kim as the lead portfolio manager, but they have slightly different exposures. BAI is really focused on the artificial intelligence theme and looking across that AI value chain, not only trying to look for what are the best opportunities today in the value chain, which right now is really kind of in the digital infrastructure space, but also looking to pick winners within those sections of the value chain. Which companies does Tony and the PM team really think are going to have the most long-term structural growth associated with them? TEK is our Technology Opportunities Active ETF, and that's really looking across the entire tech sector. So yes, artificial intelligence is of course a component of that strategy, but this is really looking at both mega cap and small and mid cap companies across global technology that are leading in various different segments and themes in the technology space.
Yeah, and again, when you talk about these advisors and investors, you talk about going beyond the Mag 7. It sounds like you guys have a team of qualified experts behind you to help advisors and investors when selecting stocks via this ETF. So how do you then see ETFs like Tech and BAI used inside a diversified portfolio?
There's really two ways that we see people allocating to these funds. One is because the S&P 500 is so top heavy in the Mag 7 and in technology stocks, that you can simply sell down some of your core equity exposure and use what you've sold down to allocate to a fund like BAI or TEK to get that AI, to get that kind of more refined AI exposure. So imagine you're kind of selling down Mag 7 and you're replacing it with a more thoughtful, actively managed approach to the entire AI value chain. The other way that we see it being implemented is with advisors who have sector breakouts in their portfolios, specifically if they have a tech sector sleeve, selling partially or entirely out of the tech sector, replacing it with BAI or with TEK, allows you to more actively navigate the opportunities in the technology sector. When you look just at the beta, the plain index-based approach to the tech sector, not all of those companies are innovative or participating in long-term structural themes. In many instances, some of these companies build desktop computers, build printers. It's not at the cutting edge. But if you want to allocate to this tech sector, many advisors are doing so to capture those growth opportunities. So selling down tech, allocating to an actively managed fund like BAI can really help enhance that growth characteristic in their portfolio.
It is a brave new world. Jay Jacobs, thank you so much for joining us. It's good to have you.
Thank you.
And that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. We want to give a big thanks to all of our guests, along with Maital Legum at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.